Good day everyone, we are from Group of Manufacturing. Manufacturing sector is an important sector in Malaysia economy as it contributes positive economic benefits such as job opportunities, business for local demand and also export to foreign countries. In 2016, Malaysia has recorded 1.07 trillion of approved investment in the manufacturing sector. In first quarter of 2017, the manufacturing sector was the second largest contributor to Malaysia's gross domestic product, known as GDP, at 22.8%, while the first contributor is the service sector. Manufacturing sector in Malaysia continues to play an important role in the economy. Hence, it needs to continuously focus on the sector to improve export numbers in making of growth more sustainable in the long run. Every business will face business risks, which refer to factors that can have negative impact on firm's profitability and the performance. In general, business risks come from internal factors, we also call the firm-specific factor, and the other one is external factor, we also known as macroeconomic factor. Hence, this research is to study the factors that can affect the performance of company that we selected. By identifying the factors, necessary action can be taken in order to mitigate the risk and hence improve the performance of the companies.
There are three research objectives. First is to investigate the firm-specific factors towards the performance. Second, to examine the macroeconomic factors towards the performance. And the third is to analyze the firm-specific factors and macroeconomic factors towards the performance. Additionally, the research question also have three questions, which are: is there any relationship between firm-specific factors and performance? Second, is there any relationship between macroeconomic factors towards the performance? And last, is there any relationship between firm-specific factors and macroeconomic factors towards the performance?
I'm going to talk about literature review. Literature review is what some scholars said. First of all, financial risk. Financial risk is one of the high priority risk types for every business. Financial risk is the cost due to market movements, and market movements can include a host of factors. According to Antinous and Gonzalez, 2015, defined financial risk of firm as the result of selection of alternative financial situation by its owner or managers that aim to achieve their desired target financial performance with possibility of incurring economic losses. In addition, financial risk also refers to the degree of uncertainty associated with the combination of debt and equity of firm. The second one is profitability. Profitability is the ability of a business to earn a profit. A profit is what is left to revenue a business generates after pays all expense, directly related to the generation of the revenue, such as producing a product and other expense related to the conduct of a business activities. There are many different types of analysis profitability. Let's look at a few of primary analytical approaches, which is net profit margin, gross profit margin, and operating margin. According to Smith and Rees, 1999, business performance is defined as the operational ability to maximize the wealth of company's major shareholders, and it must be assessed to measures of the accomplishment of a firm. The third one is liquidity risk. Liquidity risk is the risk that a company or bank may be unable to meet short-term financial demands. This usually occurs due to the inability to convert a security or hard asset to cash without a loss of capital or income in the process. We can find the study from the Westphalia of Shukri and Shukri 2016 showed that a liquidity ratio is positively significant with ROF performance, which is indicate that a conservative strategy is adopted by the Islamic Bank in managing liquidity problem by maintaining sufficient cash reserve, and at the same time these banks are able to generate profit. The fourth one is credit risk. Credit risk is the risk that a borrower defaults and unable to meet its short-term obligation to uh, service the debt. It can occur when the counterparty is unable to pay or cannot pay on time. In addition, Gulami and Salmi 2014 study shows that the credit risk performance of company are interrelated. They conduct one of such researches study in which have to investigate the relationship between credit risk management and liquidity management, also profitability in the banking sectors. The fifth one is operational risk. According to Basel Committee 2003, operational risk is defined as the risk of loss resulting from inadequate or failed internal process, people and system, or from the external events. It includes legal risk but excludes strategic and reputational risks. Additionally, from Cruz 2002, operational risk result from system failures, product anomalies, fraud, and governance malpractices, and natural disasters. For instance, human resources are also one of the factors in contributing to operational risk, because any fraud, corruption, and embezzlement will causes a huge loss to company operation. The last one is a market risk. Market risk is the risk of losses in liquid portfolio, which is arising from the movement of market prices and consisting of interest rate, currency, and equity and commodity risk. Is also a subset of microeconomics that measures the changes from the aspects of economic condition. According to Santamario 1997, market risk by a nature can be hedged but cannot be diversified away completely. Basically, net interest margin used to measure the market risk, which is reflects the market risk arising from changing market condition where it can harming the bank.
I will talk about the research methodology. Research methodology is the process used to gather the information and the data for making decisions. The methodology may comprise of publication research, surveys, interviews, or other research techniques on present and historical information. It can be said the research methodology is selecting the correct method to come out with favorable outcomes. The purpose of method is to achieve the study's objective and expected to get a good result. In this study, the various methods are used to study the relationship between the performance of food and beverage industry in Malaysia and its determinants. The SPSS version 25 is the method used to analyze the data. The second point is the population. In this study, organization will be the unit of analyze. The population is manufacturing companies in food and beverage industry in Malaysia. Well, the samples choose from the 5 companies. The data are collected from the annual report of each company from year 2013 until 2017. Then the data is used to measure the dependent variables and independent variables. In this study, the DV is film performance, the AV is specific factor and macroeconomic factors. The third point is statistical technique. In this study, the ordinary least score regression is used to analyze the research data. The OLS is one of the most techniques that commonly used to analyze the data in a research. The OLS, or linear least score, is a method for estimating unknown parameters in a linear regression model. The OLS regression is a technique of generalized linear modeling that may be used to model to a particular response variables which has been recorded. The technique may be applied to single or multiple explanatory variables. The last one is SPSS. To compute the data collected, the SPSS version 25 is used to analyze and get the result. This SPSS software is easy to use, is flexible and scalable. It allows the user with different level of skills, size, and complexity to access IBM SPSS. And in this study, the data obtained from the annual report of 5 companies.
We use the financial statement analysis to review, identify, and evaluate the trend of the companies by computing the ratio over the 5 years period. Firstly is the profitability. For the profitability, we use the ROA as the measurement to present the performance of the company. We can see that the 5 years average ROA for the 5 companies is 10.70%. This means that the benchmark percentage of profit a company to generate in relation to the company's resources. So the higher the average ROA over the 5 years, the better the management of company's asset to generate the income. Based on the graph above, it can be seen that the FNN has the highest average ROA from 2013 until 2017, which is 16.03%. However, this value has exceeded the benchmark by approximately 5.33%. The second highest average ROA is belong to the Ajinomoto, with the average ROA of 14.12% and followed to the United Plantation with the average ROA of 10.81%. However, both average ROA also exceeded the overall average return of asset. Therefore, it can be concluded that FNN, Ajinomoto, and United Plantation have managed their company's asset well and fully utilized it to generate the profit to the company. Besides, there were 2 companies' average ROA did not reach the benchmark of 10.70%, which are Apollo and London Biscuits. So for a better performance, both companies need to improve the efficiency in managing its assets to achieve the benchmark in the food and beverage industry. Additionally, the standard deviation of ROA for the companies over the 5 years is 7.33%. This means that there are some companies achieve 7.33% more or less in the average of ROA. Thus, companies should find some ways to increase the income without increase the asset cost, like export the new market segment and targeting the new customer. Second is the liquidity risk. We use the average current ratio as a measurement of liquidity to measure how many dollars of short-term assets are available for every dollar of short-term liabilities, all throughout the 5 years, which from 2013 until 2017 for each company. The mean for benchmark of average current ratio is 12.62 times. This value implies that among the 5 companies have 12 ringgit of current asset in order to make the debt payment. Based on the graph above, it shows that FNN has the highest current ratio with 13.93 times among all the 5 companies. This implies that the FNN has 30 ringgit of current assets to pay the 1 ringgit of the current liabilities. It is the lowest liquidity risk among the 5 companies, and it can more easily to make the current debt payments. However, the London Biscuit has the lowest current ratio with 0.93 times among all the 5 companies. It is exposed to the highest liquidity risk since it only has 0.93 ringgit of current assets to cover the 1 ringgit of current liabilities. The ratio, which less than 1, indicates that the company may have the difficulty meeting the current obligation. Company had to make sure the assets are always liquid when company short of the funds. Moreover, the other 3 companies like Apollo, Ajinomoto, and United Plantation have sufficient current ratio and show the ability to pay the short-term obligation. Besides, the standard deviation of current ratio has a value of 22.20 times among the 5 companies. This value implies that the larger disperses between one company and other company in current ratio over the 5 years periods. Hence, company should find some ways to increase the profit by liquidate the asset by reducing using the inventories and other expenses. Next is credit risk. We use average collection period for each company as the measurement of credit risk to present the performance of the company. Credit risk refers to the risk which a borrower may not repay a loan and that the lender may lose the principal of the loan or the interest associated with it. The mean value analysis indicates that most of the companies need 82 days to collect back the cash over the 5 years. The average collection period defines that the average number of days run out between a credit sale and the days the company receives the payment from the credit sale. So the higher ratio of ACP indicates a higher credit risk. Based on the figure above, it can be seen that FRM had the longest average of ACP from 2013 until 2017, which is 114 days. This means that the FRM had poorer collection procedure since it takes a longer time to collect back the money among the 5 companies within the 5 years. It may unable to convert the asset quickly into the cash to cover the debt payment with the high days sales ratio. The value also exceeded the benchmark by approximately 58 days. Next, the second largest average ACP is belong to the London Biscuit with average ACP of 133 days and follow to the United Plantation is 65 days. However, both companies also exceeded the benchmark of ACP. This can be concluded that FRM, London Biscuits, and United Plantation does not manage well their company's collection period to generate the profit to the company. On the other side, Ajinomoto has the shortest average of ACP with 41 days among the 5 companies from year 2013 to 2017. Ajinomoto is efficient in collection procedure in collecting back the money in shorter period compared to other companies. It also reached the benchmark of ACP. Hence, this shows that Ajinomoto with the lower ACP ratio is more favorable because it indicates that company able to collect earlier from the customer and can use the cash for other business operation. Besides, the standard deviation of ACP is 59.55. The higher the standard deviation, the more the variation of the ACP. Hence, company must set the credit line with building the relationship with the customer by discussing the relationship with the customer with the credit terms.
Operating ratio is used to measure the operational risk. From this average operating ratio, we can see that Ajinomoto has the highest average operating ratio with 89.18% among the 5 companies. With this high ratio, Ajinomoto is less favorable because it means that the company overused the revenue to cover its operating expenses. Ajinomoto unable to manage its operation efficiently and caused the smaller margin of profit available for the company reserve. The mean of average operating ratio for 5 companies is 28.15%. Hence, the other 4 companies considered has good operating ratio over the 5 years because all are below the benchmark. Among them, Apollo is the lowest with 11.78%. It indicates that the Apollo managed its business operating efficiently. Market risk is also known as systematic risk or undiversifiable risk. There are many market indicators, but in this study we choose GDP, inflation rate, exchange rate, and interest rate as the indicator. From this figure, GDP fluctuated over the 5 years. In 2014, Malaysia has the highest GDP with 6%, driven by the positive growth of material supplies for service sector, construction, mining, manufacturing, and the quarrying sector. High GDP indicate the economy is healthy. However, GDP start to drop until the lowest 4.2% in 2016. It was due to the global financial crisis in that year. Next, inflation rate in Malaysia also non-consistent from 2013 until 2017. There was highest inflation rate in 2017 with 3.8%, supported by the weaker ringgit and the increasing transportation-related costs. On the other part, exchange rate was in uptrend from 2013 until 2017. It indicates the value of the Malaysian ringgit was getting smaller and smaller. Next, interest rate over the 5 years has not much change and is governed by the Bank Negara Malaysia. Of these macroeconomic factors may affect the performance of the companies. Beta is also one of the indicators to measure market risk. Average beta is the 5 years average price change of company stock price, calculated by adjusted cross price minus the opening price of the stock. Market beta equal to 1. In our case, all of the 5 company beta were below the market beta. Indicates that all of them were less volatile than the market. Among the 5 companies, United has the highest beta of 0.7362, means that the stock of the United was the most volatile as compared to others, while London has the lowest beta of 0.0124, means that its stock price is very less volatile over the 5 years. Hence, it can be said that the London stock price was less risky compared to other companies.
Next, based on correlation table, it can be seen that ROE is strongly positive and highly correlated to performance, as the p-value is less than 0.001. This means that companies that generate high returns will pay the shareholder handsomely and create sizable assets for every ringgit invested and thereby improve the performance of the company. Next, from specific factor, which is current ratio, as well as macroeconomic factors, which are inflation rate and beta, are weakly positive and significantly correlated to the performance of the companies, with the p-value less than 0.05, whereas the operational risk, GDP, and exchange rate has positive correlation to performance, but is not significant to the performance, and therefore it shows no relationship with the dependent variable, which is the performance, as a p-value is greater than 0.1. Next, based on coefficient table, ROE and beta were found to be highly significant in explaining the performance of the 5 companies under food and beverages manufacturing sector. Besides that, current ratio with p-value less than 0.1 indicates least significant influence on the performance of the companies. Move on. Based on the model summary table, the adjusted R-square of 0.996 indicates that all of the variables in Model 3 are able to explain about 99.6% of the variation in the performance of the 5 companies. This shows that the model is highly reliable and respectable. As referred for the ANOVA table, the p-value of 0.000 implies that all of the variables are perfectly significant to represent the model. In other words, significant value of 0.000 is highly acceptable and signifies the model of a study is highly reliable. Based on the findings, it can be concluded that firm-specific factors as well as macroeconomic factors influence the performance of the companies. As shown in correlation table, RE has a more significant influence and is positively correlated to the performance. By contrast, based on the coefficient table, RE and beta has a more significant influence and are positively correlated to the performance. Next, current ratio as well as inflation and beta were found to have influence to the performance with p-value less than 0.05, which shows a big positive and moderately significant correlation to works performance. Next, we'll discuss about the limitation of this study. First of all, due to time constraint, only a small size of population, which were the 5 companies listed in Bursa Malaysia and the food and beverages manufacturing industry, and hence might not represent the majority of the companies under food and beverages manufacturing industry. Besides, the study also limited and covered only the financial statements for a period of 5 years, ranging from 2013 to 2017 for each company. In addition, it is notable that these financial statements in annual report do not show how well the company performs in a given market and the exact worth of the company. For instance, different accounting practice can distort comparisons within the companies even in the same industry. In other words, financial statements provide limited information in conducting this study. Based on the findings, return on equity has a more significant relationship towards the performance of the companies. Hence, companies could drive out its ROE by means of increasing profit margin, asset turnover, and also leverage. However, it should be noted that high level of debt can lead to high default and bankruptcy risk. Apart from that, market risk also has significant relationship with performance as represented by beta. Hence, these companies should manage its market risk well by hedging the price of the raw materials through derivative market. Last but not least, some recommendations for future research are to extend the analysis on larger samples from fine to larger numbers, or by extending the scope to more industry sectors in order to find out which variables has the most explanatory power on company performance over time. Thank you.